I'm Janessa from ABC, and I want to thank Jennie and Jason from Beneco for presenting on prevailing wage basics for us today. This class is being recorded and will be presented on the ABC On Demand page at abcwestwa.org sometime tomorrow. So without further ado, I want to turn the mic over to Jennie. Thanks, guys.
Good morning, everybody. Thank you so much, Janessa. Thank you, ABC, for having us. We appreciate everybody being here. So let's get started with the agenda. Who is Beneco? What do we do? We will talk about how does the Davis-Bacon Act apply in Washington, and then we'll get into wage determination and fringe dollars, and then we will finish up with certified payroll and overtime calculations. So let's get into who is Beneco and what do we do. So Beneco has been in business now for about 35 years plus, serving clients coast to coast. We are a trusted name in the construction industry, working almost exclusively with contractors that are doing prevailing wage work. So over the last 10 years, we have had over $700 million in prevailing wage contributions to our benefits programs, which has saved our clients over $125 million in labor burden. So because of the specialization in what we do, so we were acquired by a census. So Beneco falls under the future plan line of business. So just a little background, a census is the largest independent record keeper in the United States, along with future plan being the largest third-party administrator of retirement plans. So that really gives us the backing of a larger company, plus additional resources. So just wanted to quickly throw this up. We're really proud of our partners that we have here. We're part of 12 ABC chapters throughout the country, as well as AGC, IEC, and NUCA. And then let's get into what does Beneco offer. So we offer solutions that keep you in compliance with your prevailing wage work. So that includes record keeping and third-party administration, as well as benefits consulting services. And then some of the other employee benefits that we offer would be retirement 401k, life insurance benefits, medical and ancillary benefits, and then lastly, HR and compliance services. So while we provide solutions necessary for you to stay compliant when it comes to government contracts, these benefits help to retain your key employees and also attract new employees. So again, all of our solutions are designed to use fringe dollars to keep you in compliance and reduce costs. So let's get into the Davis-Bacon Act. How does it apply in Washington? So as you know, a couple of years ago, a major infrastructure bill was passed, and a lot of those projects are now being funded, and contractors are starting to work on these projects. And what we're seeing is that there is a lot of difficulty for these contractors to find the right employees to actually do the work and then keep those employees. So what's nice about Davis-Bacon is that there's money within those contracts that provide solutions and benefits to help retain these key employees. So what is the Davis-Bacon Act? It is a federal law requiring contractors to pay at least the locally prevailing wages on all federally funded projects nationwide. So regardless of where you're located, this applies in all states. Now, in certain states like Washington, this applies to state and locally funded projects as well. So if you look at the map, you'll see that there are states in gray and states in red. The gray states have state and locally prevailing wage regulations. The red states do not. So for example, Jason and I are here in Arizona where these regulations apply only to federally funded projects. Any projects that are city, state, or county here in Arizona are not subject to prevailing wage regulations, where in Washington, those projects would be. And then another thing to keep in mind is that prevailing wage rates do vary based on location and by craft. So there can be some significant differences in rates depending on where you are located. So again, prevailing wage laws apply for all federally funded construction projects in excess of $2,000, regardless of what state you are in. In Washington, all public works and maintenance contracts would apply. So let's get into who does this apply to. This would apply to laborers and mechanics who are doing the work physically in nature on those qualifying projects on the job site. It generally does not apply to owners or office staff because they're not doing the physical labor at the site of work. There are some exceptions, but as a rule of thumb, we would say it just generally applies to those who are physically on the job. Let's see. So we're going to get into wage determination fringe dollars, and I'm going to pass this over to Jason.
Perfect. Thank you, Jenny, and thanks again to ABC Western Washington for having us and everybody for joining us here this morning. Still kind of morning, so thanks for joining us. And we're going to jump into wage determinations, how those are looked at, calculated, some examples, and then get into the fringe dollars that are part of that wage determination. So where do you find the wage, or what is a wage determination, and where are you going to find that? So the wage determination is what actually, where you would reference the wages that are required to be paid on any prevailing wage project. So in the state of Washington, you'd find that on the state L&I website. We have the link there, and we can share that'll be shared with afterwards, where you can go online and find the wage determinations. Like Jenny said, they can vary drastically by location. So even within the state, you know, if you've typically done work around the Seattle area and you have a job that you've won in more Eastern Washington, say around Spokane, make sure you keep in mind the different wage determination sheets that may apply by different regions, and then obviously by different crafts. But another common question we get is, how are these rates determined? How are these rates determined? You know, most people have the opinion that the wages that they would deem to be prevailing in the area are lower than what the published prevailing wage rates are. And how that's determined is based on different wage surveys that are sent out. So always encourage people to complete those when they have those. And also they're largely impacted by the union wages in the area. So that's where you're going to see where that amount is calculated from. In most cases, generally, once they're assigned, they stay assigned for the rest of that project, for the duration of the project. Remember, there could be multiple determinations, and like Jenny said, they vary by geographic region and by craft. So here's an example of a wage determination from Washington. This is for a journeyman electrician. This example is actually out of Spokane, but where they give us for the state of Washington is the prevailing wage rate is $61.86. Then they also have notes in there for holiday time and overtime, but that wage that you read here, it's all encompassing for Washington of the base wage and the fringe benefit amount, where you can reach that total wage that needs to be paid of $61.86. I think we have another example later. I'll show some from some other states that kind of break it out differently, but this is an example of how they look there in Washington. So with that being said, and I kind of mentioned this, but what is all included in that prevailing wage rate? The prevailing wage rate is made up of a base wage, so an hourly amount that is to be paid to the employees as their base wage, and then a fringe benefit amount. So it's a dollar amount that can be used from that total to pay for fringe benefits for those employees. You add those up and you get the total prevailing wage rate, which we just showed you is a little over $60 for that journeyman electrician. So that's what makes up a prevailing wage rate when you're pulling that from the wage determination sheet. Now, another important concept or thing that we want to go through is to discuss what is labor burden. And any of you in the audience that are involved with your company's bidding process, you're probably familiar with your labor burden rate. It's basically the cost of paying your employees their hourly wage. If an employee is earning $50 an hour, it costs the company more than $50 an hour to pay them that wage, and actually substantially more. And the reason for that is you have what's included in your labor burden is your payroll taxes, so your FICA tax, your federal and state unemployment taxes, your workers' comp and general liability premiums that are oftentimes based off of payroll. So those can vary, but oftentimes in the construction industry, we'll see that averaging around 30%, meaning that for every dollar that you pay your employees in wages, the company's incurring a cost of an additional 30 cents. And then we're going to get into how that impacts how you're paying those fringe dollars to your employees, those fringe benefits. If you're paying them as cash wages on their paycheck, you're going to be paying that labor burden on all of those dollars, or conversely, different dollars that are used for benefits programs, you can remove them from payroll and avoid paying any of your labor burden on those. So going through some definitions of fringe benefits. So I mentioned that the fringe benefits are a portion of the prevailing wage rate. there are some definitions for what fringe benefits are and some methods for how the employer can use those dollars and what they can pay for. So fringe benefits is an amount of money from that prevailing wage rate that has been used to pay for a benefits program. They need to follow prevailing wage regulations of having a third-party trustee and the funds be contributed to a bona fide fringe benefit plan, fund, or program. I'll get into those definitions in a second, but one of the key points here is under methods of pay. So the methods for how you pay that fringe amount to your employees, the total prevailing wage rate, can be met by any combination of approved benefits, creditable bona fide fringe benefits for a covered worker, and cash wages. So it is up to the employer how you pay that to the employees. Out of that $60 an hour, we'll go through some examples, but the employer could decide $20 an hour is going to the retirement plan. And if it's set up properly with these regulations in mind, you could put $20 an hour into the retirement plan, and the rest could go as cash wages or any combination of cash wages and other approved benefits. Some of the definitions there, we had mentioned that it needs to be paid, or that these prevailing wage programs must be into a bona fide trust. Basically what that means is that the fringe benefits are made to a trustee or third person irrevocably and must be pursuant to a fund, plan, or program. That third person must not be affiliated with the contractor or subcontractor, and the trustee must assume the fiduciary responsibilities imposed upon trustee by applicable laws. So really what that's saying is, for example, the company cannot hold those prevailing wage dollars back and keep them in a company account to then use to pay for something down the road. They need to be paid into a planned fund or program irrevocably, meaning that the company cannot pull them back out. They can't be forfeited. They're in that employee's name and cannot be lost. And there needs to be a third-party trustee on that plan that takes on that fiduciary responsibilities. So all of this is laid out in the Department of Labor Handbook on Prevailing Wage Regulations. Those are kind of some key points and the basis of what all of our programs are designed by to meet those regulations. So the different approved methods of how you pay fringe dollars to your employees. You have pension and retirement, health and welfare, ancillary benefits. That includes dental, vision, life, disability. Vacation and holiday can be paid from fringe dollars, and a qualified approved apprenticeship plan. So you're not able to use any of this money to pay your employee's cell phone bill, put gas in a truck, uniforms, things of that nature. It has to be one of these categories that those dollars are being used for. So there's obviously a lot of rules and regulations, things that apply to these prevailing wage benefits programs. So, you have to make sure that you're compliant with those, and everyone, so make sure they're not getting in trouble with anything they're doing. So you're wondering oftentimes, why would I go through that work of making sure my programs are set up to meet those requirements when I have the option of just paying the entire prevailing wage rate out as cash wages versus paying into a benefits program. So I'll give you some examples here on really the impact on the business, the benefits to the business of offering some programs and funding them with prevailing wage money, and then also get into the benefits to the employees. And as Jennie was alluding to, the labor market is very competitive now, and the better employee benefits programs that you can offer, the more competitive you're going to be in that labor market. And this is a great way to pay and fund for those programs. So a lot of benefits for the employees and for the employer alike. So I mentioned that I did want to show you a wage determination example from outside of Washington. This one's from California. And just the reason I do this is for visually, it does a nice job in California and in most other states of breaking out how the fringe amount is actually allocated and what makes up the total prevailing wage rate. So Washington's a bit unique in that they just give you what the total prevailing wage rate is, that's $60 an hour or whatever the amount is. In other states, such as California here, you will see that total is actually broken up into different categories. You have a base hourly rate of $54, health and welfare is $11.85, pension is $13.80, vacation, holiday, training, and other for a grand total of $87.81. So those are the different components that make up the total prevailing wage rate. Like I said, in Washington, in this example, they would just tell you $87.81. Or in other states, they'll actually break down the different categories, what the base is and what the fringe rate is. So again, how you pay that fringe rate to your employees is completely up to the employer, and you can do so by any combination of these benefits. So that entire amount, whatever you deem to be the fringe rate for your employees, that entire amount could go into the retirement plan, or it could just go into health and welfare, or it could be retirement and vacation. The rest is cash wages, or however you would like to do that is up to the employer, just as long as you're meeting that grand total amount. So getting to some examples here on the impact to the business, what that's going to look like. So the first example here on the top is if you pay that entire prevailing wage rate out to your employees as cash wages on their paycheck. So we'll round the numbers a little bit, but the example we looked at in Washington was a $60 an hour wage for that journeyman electrician. So if you're paying them $60 an hour on their paycheck, you're having to pay $18 an hour on labor burden is the cost that the employer has to pay. That's 30% of that amount. Is what your total labor cost is going to be when calculating your bids. And what you're actually paying is $78 per hour. Conversely, if we pay the employees $40 as a base wage and put that remaining $20 into a fringe benefit program, into a bona fide trust, you're only paying those payroll taxes, workers' comp, general liability on the base wage. So 30% of that $40 is $12. Yeah, that's $52 an hour is your labor cost, and you still have to pay the $20 fringe, the $20 fringe amount, but it's just into a bona fide trust instead of cash wages. When you do it that way, you're reducing your labor cost by $6 an hour. So $6 an hour for every employee on every project, every hour that's done on these prevailing wage projects. As you can imagine, reducing your labor cost by $6 an hour goes a long ways to the bottom line and into your bidding power on these projects. So looking at what this can mean kind of over the course of a year for an average contractor that does prevailing wage work, let's say half of the year. So if an employee is doing this type of work, let's say 1,040 hours, which is half of a full-time employee's workload, the company's saving $6 an hour for every hour that they work, which comes to $6,240 per year that you're saving for every employee. If you have 25 field employees, that comes up to $156,000 a year that you're saving in unneeded expenses on taxes and insurance premiums that nobody wants to pay more of. And it's something you can very easily, just changing methods of how you pay your employees can save the companies well over $100,000 a year in a lot of examples. And kind of going back to the bidding process, I was just having some conversations earlier this morning. We always hear stories where a company may lose a bid by a large project by small dollar amounts. I have stories losing a project that would have been several months of work, for $10,000, $15,000, $20,000. You can see how a strategy like this can allow you to make up that difference. Or oftentimes we'll talk to a contractor that has never won a prevailing wage bid, or they win very few of them, and they're always wondering how their competitors are always underbidding them and winning these, and how they're making any money on these jobs with the price, with what they're bidding. And oftentimes one of the main reasons is because they have a program similar to this in place that allows them to be more competitive on those jobs. And that's something I think we're going to see more competition on with, it's been about a year and a half since the infrastructure bill passed, and more of those projects are coming up and are being funded. And where the economy might be going for the private sector, there's some uncertainty there. I think a lot of contractors are seeing these prevailing wage projects, these public infrastructure projects, as being a good source of business going forward, more consistent work and more projects than what you might see on the private side, increasing the competition, where if you're not doing something like this, it's going to be harder and harder to continue winning these jobs or to break into that market. Taking this a step further, looking at we looked at what the labor savings results are to the company. Now let's take in mind, what are we doing with all of those prevailing wage dollars that we decided we want to use for benefits? So if you use those same dollars, if we decided we wanted to have $20 an hour go to benefits for these employees, they worked half of the year on a prevailing wage project, that total is $20 times 1,040 hours is $20,800 a year that the company has basically been awarded from whatever awarding agency funded this project. You've been awarded that money to pay for benefits programs for that employee. So you basically have a $20,000 budget to provide this employee with benefits for the year. If you take that again times 25 employees, it's $520,000 that the company has at its disposal to pay for different employee benefits for those employees that are doing this type of work. So the dollars really add up there quickly and allow you to do a lot of great things with your benefits programs, on top of the labor savings that you're receiving. So again, like I mentioned, you're using that money to reduce the cost of your benefits programs in addition to the labor savings that you're seeing. So you can use those fringe dollars to pay for your health insurance plan that cover the employer's portion of your health insurance premiums. You can use it to fund a paid time off program. So instead of the company using their own company dollars to pay for that, you're using prevailing wage money, or maybe it's something that you haven't offered in the past, or any paid time off, a way to do that with prevailing wage money. Also a health reimbursement account. The employees can use that to pay for medical expenses of tax-free fringe dollars and money going into the retirement plan. Now we're touch on a little bit more detail on some of the different benefits programs that are out there, some of the kind of key points to keep in mind if you have them currently or what you're looking to do in the future. But any type of health insurance plan can be funded with prevailing wage dollars. So your standard fully insured plan, minimal essential coverage, also your self-funded and level funded plans. The self-funded plans can get a little more tricky with how you need to administer them, but they can all be funded with prevailing wage money if you're doing this type of work and have one of these types of plans in place. It can also include dental, vision, life, disability. Any of those programs can also be funded with this prevailing wage money. And one of the ones that the employees and everybody really seems to like the most is the health reimbursement account. So an HRA program, it's basically like a medical debit card that the employees use, that they receive, that's funded with this prevailing wage money that they can use tax-free to pay for medical expenses. So they can use this to pay for prescriptions, deductibles, copays, etc. All employees are eligible for it. There's no maximum contribution limits, no minimums. It rolls over year to year, so there's no use it or lose it. Anything like that is against prevailing wage regulations, so there could be no forfeitures. It's made irrevocably to the account, and it's portable. So the employees, even if they leave employment, they can take that with them and continue to use it for medical expenses, or even if they funded it significantly before their retirement and they wanted to have that to pay for any medical expenses going forward, they've got it, and it's savings on the labor cost of the company and tax-free to the employee. So. The full list of what you can use the HRA account for is listed on the IRS website. Anything that's deemed as a medical expense that fits those requirements can be used by the card. And the best example that we like to give contractors, or that we explain to their employees, is how it works for them. Like, let's say one of your employees has a $1,000 dental bill that comes up. If they don't have a plan like this in place, that employee needs to earn probably around a little over $1,300 to have $1,000 after taxes in their paycheck to pay that bill. Or conversely, if the employer had put some of this prevailing wage money on that HRA account, the employer saved all the taxes and the employee has this tax-free money to use to pay for medical expenses. So they can pay that bill dollar for dollar with $1,000. It was tax-free for them. And another thing that comes into play in areas where there's more seasonality to the work is that the way the world seems to work, if there's going to be an unexpected medical expense, it comes up at the worst time, always. Maybe when the employees aren't as busy, you've got some layoffs or some slower time of the year, and maybe they're not earning as much money, and that's inevitably when this is going to happen. If your employees have an HRA account, they've got a couple $1,000s on there, they can sleep well at night knowing that if something like this does pop up, it's not going to affect their checking account. It's not going to affect their ability to pay their bills. They have this money set aside tax-free that they can use to pay for these medical expenses when they come up. And it can also be used for dependents too. So they have kids and they have medical expenses, as you do with kids, they can use that there too. The vacation, PTO, and holiday benefits program, you can also set aside some prevailing wage money to put in a separate account to pay your employees their vacation time. This is one program that we oftentimes see companies try to do on their own. That's by the book, out of compliance, where the company will hold some of the prevailing wage money back in a company account and then say, okay, when you take your time off work, we'll pay you this. And the problem that you run into there is that you have 90 days from the day that the employees worked to pay them their prevailing wages as cash wages or into an approved benefits program. That it cannot be in a company account. It needs to have a third-party trustee, all of this, which is how our PTO plan is set up. And really what the Department of Labor is wanting to avoid is, I'm sure everybody has the best intentions there and would pay that money to their employees, but the worst happens and some company goes out of business and they were holding their employees' prevailing wage money for their PTO plan. There's nothing there to ensure that the employees will get that money, or if they are terminated, they leave service, those employees still need to receive that money. So having it in a third-party trusted account ensures that from the standpoint of the Department of Labor. And also to keep in mind in Washington, and this varies by state, but you're not able to use prevailing wage money for the state mandated sick time law. So this cannot cover the mandated sick time hours that you have to have for the employees, but it can be used for any PTO time that you have above and beyond that. All right, so covered the health and welfare options there. Now we're going to pivot to 401k plans, give you a little high level information here on those, and then dig a little bit more into how it impacts your retirement plan when funded with prevailing wage dollars and some of your options there. So for a 401k plan currently, the employee contribution limit is $22,500. That's the most that an employee can elect to defer on their own. A lot of people think that's the maximum amount you can have per year. That's just what they call elective deferrals, or what the employee's putting in, choosing, I want to put in 5% of my paycheck every week, something along those lines. So that does not include any company match that you might offer. It does not include prevailing wage contributions. So when you include all of those, the actual maximum amount is $66,000 a year that an employee can have contributed to their 401k plan. You can have loan provisions into the plan. There's different options for distributions, Roth contributions if you wanted pre-tax versus post-tax money put in the plan, and there are hardship distributions are available if something comes up and an employee needs to access money in their accounts. Some general statistics and kind of how this applies even more so to the construction industry, and why having a plan like this in place for your employees can be so powerful for them, and looking out, your employees do a ton of work for you and allow you to run your business, grow your business. Over the years, you've got a lot of great employees that are crucial to your operation, and making sure that they're set up for retirement. In general, if you follow the news at all, there's plenty of stories out there about how Americans in general are not as prepared for retirement as you'd like to see. And unfortunately, those numbers are even worse in the construction industry. It's a trade where historically not as many companies have offered benefits programs, so they've lagged behind even the national averages. But if you looking at what the slide shows, is that the average American that's approaching retirement age, if their employer does not offer a 401k plan, their average retirement is less than $5,000 that they have saved. So obviously significantly less than where you'd like to see that. But conversely, just by offering a retirement plan for your employees, that average number jumps up to over $100,000. So a very significant difference there in the impact it would have for your staff, for your employees. And also to keep in mind, your laborers, the people working in the field on these projects, they're doing hard physical manual labor. It's going to be hard for them to work into an older age, maybe beyond the average retirement date, if they don't have the funds set aside. Conversely, like myself working in an office, it'd be easier for me to continue to work longer if I had to. But in this, in these industries, it's going to be hard on their body to keep that manual labor up for that many years. So setting them up for success and for having a good retirement, something that they'll really appreciate, and a way to reward your employees that are key to running your business. So looking at a traditional 401k plan. So this is the general plan design of a 401k plan that's not really meant for prevailing wage contributions. So this is what you'd set up for any other type of business, or even contractors that maybe didn't have the advice or expertise on how to design their plan for prevailing wage. But basically your plan is split up into two components. You have a traditional 401k plan where employees can put money in, you can have a company match, and then you also have a profit sharing option where, let's say at the end of the year, if the company wanted to do a type of bonus for the employees, for the staff, they could do a contribution, an additional contribution via profit sharing. And you've got a few different options for how the employer can do some matching programs there within the traditional 401k model. But if you're, what I'm assuming many of you on this call today are a prevailing wage contractor, really should have a upgraded version of a 401k plan, if you will, but one retirement plan that has three components within it: one for profit sharing, one for your traditional 401k for office staff, owners, everybody, and then a prevailing wage bucket. So a separate bucket within your plan for prevailing wage contributions. And what that allows you to do is a few things. Oftentimes we'll see companies will set up two separate retirement plans, one for their non-prevailing wage, one for their prevailing wage. And that just adds a lot of administrative work. It increases your risk for audits, for errors, and a lot of additional cost with maintaining two plans versus having one that can accomplish everything that the two plans are doing within one plan. Additionally, it allows you to fully take advantage of that prevailing wage amount up to however much you would like to use for benefits. Another thing that we see a lot is a contractor will just deduct from the prevailing wage rate whatever their matching amount is for the employees. So a couple dollars an hour, whatever they owe that employee as a match, they'll deduct from the prevailing wage rate. So they'll take a credit for a couple bucks an hour, not realizing that if the plan is set up like this, you can pick. There's a few testing things that apply, but in most cases, you can pick whatever amount you want, up to 25% of their wages, to put into the retirement plan. So instead of just doing a calculation based on your match, you can say, we want to do $5 an hour, $10, $15, $20 an hour from the prevailing wage rate into the retirement plan. So that gives you more options for your matching, for plan testing, to pass testing. You can use that money to offset the match, so it reduces the cost to the employer there. And we can use it in plan testing for profit sharing that allows the owners to increase their contributions that they can do, so allowing them to max out their plan to reach that $66,000 threshold, depending on how much prevailing wage work you do. But it makes a big impact on that side of the plan testing. So, getting into looking at a case study, some general examples of where most people are at nationally when they're approaching retirement is we looked at a couple examples from some employees from some of our clients just to see what these plans meant to them. So here we have a young guy, he's 31 years old. He's been working for this contractor for 9 years. He already has over $130,000 saved for retirement. That's 100% just from prevailing wage contributions. No profit sharing, no match, nothing on his own. He's already has more saved for retirement than the average person does that's approaching retirement, specifically because of the prevailing wage money that his employer decided to put in the plan for him. Another example, Richard was age 56. He's getting a little bit closer to retirement. He's been with his employer for 16 years. He already has over $500,000 in his account, and 80% of that was from prevailing wage contributions. The rest was from money he put in on his own or some profit sharing from his employer. But the majority was just from these projects. So you can compare those to where we started with what some of the national averages are. And if you're really looking out for the long-term interest in your employees, you want to reward them for what they do for you, and make sure they can retire when they want. A plan like this can accomplish those things for your staff. So breaking down the numbers that we discussed, kind of looked at the beginning, how much prevailing wage money a company might have at their disposal if they're doing this type of work for half of the year with 25 employees using 20 bucks an hour. They have $520,000 at their disposal to use for benefits. And like I said, you can split those up into the different benefits programs and cash wages in any combination, just as long as you're reaching the total amount. But as an example of how this might look, you could have from that amount, the company used $100,000 to pay for health insurance premiums for their employees. So they reduced the cost of their health insurance plan by $100,000, paying for that with prevailing wage money. $50,000 might have been used for the PTO plan, $50,000 for the HRA, the medical debit card, and then having $320,000 left over into the retirement plan to help with profit sharing calculations and offset any company match. A significant amount there going into the retirement plan, setting your employees up that way. So that's kind of how that can look depending on what you're wanting to set up for your staff. Another thing that I wanted to touch on a little bit here, this is kind of something new that we're getting a lot of questions about. Secure 2.0 Act was some legislation that was passed the end of December just last year. And it's a variety of different provisions all related to retirement programs within the United States. So a variety of different things, really the goals there with the passing of the bill, and there's some stuff from it that's in effect today that went into effect immediately, and some provisions will be enacted over the next several years. But updating retirement plans to make them more accessible and improve them really for the employees, and also to incentivize small businesses specifically, but any businesses, to set these types of plans up for their employees, knowing how it'll affect what they're going to have saved for retirement when that time comes. So all in all, there were 92 law changes as part of this act. It applies to virtually all retirement plans. And I have a few different ones that I want to highlight here that I think is specific to our audience, to the construction industry and smaller businesses that are maybe looking to set up a program. So I think kind of already covered this. The goal of it was really to increase retirement savings amounts, expand the coverage, make more people eligible, have some protections there on revenue provisions, preservation of income, and clarifying and simplifying some rules. I'm not sure how much they're all simplified or clarified. There's still some questions in there, but for the most part, that was kind of the goal of the act when it was passed. So the first aspect of it that I want to cover here is the small employer plan startup credit. So for any employer that's currently not offering a retirement plan or not offering a 401k plan, sorry, if you have 50 employees or less than 50 employees, you can get a tax credit, not a tax deduction, but an actual tax credit where you're getting 100% of the money back as a tax credit for any startup cost for a plan up to $5,000, which the plans are significantly cheaper than that. So you can get a tax credit for any of the cost of setting up a plan, meaning that there's no cost to the company to set up a plan. And additionally, if you're paying any of the administrative costs, you can also get tax credits for those up to $5,000. And these, you start off at 100% and they phase out over the next 5 years. But for the first several years, there really should be no cost for a small employer to set up a 401k plan. And there's also some additional tax credits for contributions made to the plan from the employer for your employees. So prevailing wage money even counts for that, where you could get an additional tax credit of up to $1,000 for every employee that's in the plan. So if you got more questions about that, we can answer those, talk to your CPA, but there's a lot of great tax incentives for setting up a plan and for funding those plans and different things that can reward a business for doing those. And this also comes from, there's becoming more and more states that are implementing state mandated retirement plans. So I think that's something we'll continue to see more of. And this just kind of shows whether it's being mandated by different states or incentivized, that there's a lot of things going on to persuade companies to offer a plan like this, knowing the value that it has to their employees. Another key item in here that we see that I think is relative to in the construction industry, and maybe more so again in some of the areas that there's more seasonality, where you might have part-time employees or employees that don't have full-time status, is they changed the rules around long-term part-time employees. So what they were seeing were there were some people that were working part-time, but for several years for an employer, and they might even be there 5-10 years as a part-time employee, but they never became eligible for their company 401k plan because they were not a full-time employee. So to address that issue, they have this new provision related to long-term part-time employees, stating that if an employee's been there 2-3 years as a part-time employee, that they then need to be eligible for the retirement plan. So if you currently have a plan in place and you think that might apply to you, it's something you'll definitely want to look into and make sure that you have your plan updated and are following those regulations for those part-time employees, that they have eligibility when they should. All right. So I was extrapolating a little bit of what we're looking at over the course of 5 years and the impact that it can have on a business, and a lot of the people that we work with, said really using this as a strategy to grow their business. We see that a lot where a company becomes more competitive on these jobs, and over the course of a few years, it goes from a small amount of the work they were doing to a significant amount, and really using this as a growth strategy to grow their business. But if you're looking at over the course of 5 years from the numbers that we've been using in the presentation, over the course of 5 years, that employer would have put over $3 million aside for benefits for their employees from the prevailing wage money. That 5-year total in labor burden savings is just short of $1 million. It's $975,000 that they saved over the course of 5 years by putting all this money into benefits programs for their employees. And getting into the individual, the impact on your employees, we saw in the case studies some examples of some individual employees, how their retirement accounts grew. But again, for each individual employee over the course of 5 years, with the numbers we've been using, you can expect those employees, if they're doing prevailing wage work for half the time, to have over $80,000 set aside for retirement in 5 years. And that employees are saving over $20,000 in taxes at the same time. By doing this, it reduces their taxable income. So it's a tax saving strategy for the employees as well as the employer. And going through, like I said, we used in these examples, it's up to the employer how they want to use the prevailing wage money. But if you utilize the full $520,000, you used all of that for benefits programs, the company saved $156,000 in labor cost. And it's done at no cost to the company. There's the labor savings, there's the reducing the cost of benefits. And the only cost or any of that portion, the savings that's used, you could say, is the portion that paid for the vacation time. When the employees take vacation, those funds are paid back to them. That money does get run through payroll at that time. So there is the payroll taxes paid on just the vacation plan. So that's the only kind of portion of that savings that you could say you used up. But you were still funding that plan with prevailing wage dollars instead of company dollars, which is still at a significant savings to the company and an added benefit for the employees. Okay. Now we're going to get into some of the basics here of certified payroll, and then also on some overtime calculations, because we always get a lot of questions about that. So what is certified payroll? So if you're new to prevailing wage or have not done it in the past, certified payroll is a special report that must be filed weekly, where basically you're submitting a file and you are signing off on it. You're certifying that you as the employer paid the employees that did prevailing wage work the correct and accurate prevailing wage wages based on the wage determination sheet. So basically you're signing off, you're agreeing, you're letting the agency know that yes, indeed, I did follow the wage determination sheet and I did pay the employees the required prevailing wage rates on this project. So when you're submitting these certified payroll reports, if we have this question too, if you have a correction from a past week where there was a mistake made, you don't want to do that on the current week's file. You just need to keep that with what actually happened in this week. You can go back and make amendments to past certified payroll reports. And on there, you should include the employee's name, their ID, hours worked on that project, work classes, rate of pay, fringes, taxes, etc. So that's all the information that would be included in that certified payroll report that you need to submit. And jump back here for a second. One other thing that I wanted to show you too on here, this is something we get questions for, is that it's kind of small on the screen, but if you notice for this employee, they had hours, or this employee, they did not have any hours on Monday and Tuesday, then they had hours the remainder of the week. It's oftentimes where you'll have, a crew that's maybe working prevailing wage for a couple of days, then they go to a private job for a couple of days within the same week. On this report, you're only including the hours that the employees actually worked on the prevailing wage project. So even within that week, if they spend a day on another project that doesn't apply to prevailing wage, those hours are not included on the certified payroll report. It's just for the hours done on that project. Now jumping ahead. So for the next portion of the certified payroll report, where you're signing off on it, there'll be some forms can look a little bit different based on different states, and whether it's, Washington, you're all submitted online now, but if the fringe benefits are paid to approved plans, funds, or program, how do you notate that? There'll be a checkbox that you check, basically saying that the fringe benefits were paid to an approved plan, fund, or program. You can put there in the notes that was paid to Beneco or paid to whatever program you have in place that fits those requirements. Or conversely, if the fringe benefits are paid as cash, then there'll be a checkbox there saying that those fringe benefits were paid as cash wages. They still received the full prevailing wage amount, but those fringe benefits were paid as cash versus being paid as a benefits program. Getting into overtime, and on the Washington wage determination, they give you some guidance for overtime pay. But this is something that we see companies oftentimes making mistakes on. I guess somewhat fortunate for them, they generally, if anything, are overpaying, which keeps you from getting in trouble, but it's not always the best for the bottom line, is that regardless of whether your employees are working straight time or overtime hours, whatever the hour is, you always have to pay the fringe benefit amount. So that has to be paid on straight time and overtime. However, the fringe benefit amount does not need to be paid at time and a half for overtime. So in this example, you have a base wage of 40, a fringe rate of 20. See their working overtime hours. That overtime rate would be $60 an hour. That's time and a half of the base plus the $20 fringe. So you're not paying time and a half on the fringe amount. You're only paying time and a half on what was paid as cash wages. The remaining amount stays the same regardless of if they're working straight time, overtime, double time. That amount does not change. Always like to cover that during our presentations. And that's what we had for our presentation today. I always like to leave some time at the end for a Q&A. So I don't know, Janessa, if you have some time or have any questions that have come in, but that's what you're looking at. And say again, thanks everybody for joining us here, and thanks for Janessa, Jared, the team at ABC Western Washington. They do a great job of putting on different educational events, networking, and enjoy being a part of them and the opportunity to present to everybody.